No one loves the US more than me, but right now, the US isn't the place to be. I was reading this new report which came out by Goldman Sachs, and their forecast is that for the next 10 years, the annual return you're going to get from US equities is around 6.5% per annum. The global average estimated by Goldman Sachs is 7.7%, so the US right now falls below that, which is pretty shocking. In this video, we're going to break down how you can mitigate this risk, how you can actually earn a better return on your portfolio in the long run in 10 years, and what exactly does this Goldman Sachs report say. Now, why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital, based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. The expected return for US equities in the future is around 6.5% per annum on average. The reason why this is because of the US's high valuation and high PE multiple right now. Valuations alone drag annual returns down by 1%. Now, the US will grow. I'm not saying that it's not going to grow. The US will still grow, but not nearly as fast as it did in the previous decade. Now, your emerging markets Asia, excluding Japan, China, India, these places, your annual return is expected to be around 10.1% according to Goldman Sachs. 10.1% per annum. That's going to be compounded 10 years. Why emerging markets are likely to crush the US in the future is because the US dollar is likely to weaken, which acts as a tailwind for emerging markets which have debt denominated in US dollars. Most of these countries offer a dividend yield of 3% and have a much lower valuation than the US. So, higher growth potential, dividend yields, US dollar weakening, all these and a lower valuation. All these things act as a massive tailwind for emerging markets. The US corporate tax tailwinds are over. The emerging markets have a higher EPS, they have lower valuations, they offer a higher dividend yield. And now it looks like that the emerging markets are going to seriously outperform the US markets. Hedge funds and professional traders are seriously overweight emerging markets right now. Last week, Goldman Sachs, JP Morgan, and Morgan Stanley had actually delivered out a statement saying that a 10 to 15% market correction will actually help the US in the long run because the valuations are that stretched right now. Yes, we're not in a bubble territory right now, obviously, but in order for the price to justify the earnings, which is PE ratio, we're going to need a correction. So it's happening. Hedge funds are cutting US large cap exposures. Peter Thiel, the VC who helped fund Meta, has just cut all his stake in Nvidia right now. Start rotating out of the US, start looking at emerging markets. I'm not saying dump your entire portfolio, but the numbers are solid. You want to be looking at getting exposure to emerging markets right now.